Hi there, everyone, and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. Alrighty, so as per usual, let's get started on the index. So this is the XJO, the top 200 stocks of the Australian market. So you can see here, the XJO has blown through that downtrend line that we're looking at only a week ago. A shot now back up to that next key level of resistance around 7,000. The short-term trend is now up with higher peaks, higher troughs, but we're in a heavily overbought condition. The market itself has pushed about 10% from its lows down at 64 here. So, nice whole round number of almost 10%. There might be a little bit more in it to get to that 10% mark. So, nice little recovery sort of happening through here on the markets at the moment. The question is, how much further will it push? Can it push any further than this before we see some form of pullback? So, I suspect so. Okay, I suspect we will probably see a pullback at least down near 68, or even our little sort of devil's number around 666 here. The market seems to love to use that level as a bit of support or resistance. So look, I would not be surprised to see our market quite a bit lower over the next few months. I wouldn't say though the next few weeks yet, because we're in the middle of reporting season. US reporting season, although it has been a bit mixed, there's definitely been some strong buying behind any stock that's showing some resilience through this recession that we're seeing in the US at the moment. All right, so at this point of time, guys, look, we could creep a little bit higher or go sideways through here, but I suspect with the market being so overbought, a bit of a pullback could happen, and it could even come sooner rather than later. It just depends on what that catalyst is going to be to drive it lower. Okay, so S&P 500's looking like it's stalling at a key level of resistance as well, right? So that's kind of big news for me, and this is why I keep thinking we might stall soon and pull back. So you got the S&P 500 hanging up near this, just below 42 here. That's a very strong level of resistance. I couldn't see us through that in the short term without some further positive news or positive catalyst, really. Yeah, that's definitely looking a bit overdone for me, toppy and ripe for a bit of a pullback. Nothing really much more to say there, guys. Same deal as our market. The downtrend line has broken for now. That begs the question of whether this is the start of the broader recovery or whether this is just, a shallowing of the downtrend, and we might be looking at something a bit more shallow of a downtrend like this. Look, I think it's still up for debate, and that debate's going to go on for the next few months. So technically, look, guys, that we've got some green shoots. Okay, that's early signs of a turnaround, but I'm not calling it yet. That's for sure. Okay, there's plenty of headwinds to come for these markets. So I'm guessing the overall volatility is not quite over at this point. Okay, so we saw the RBA lift interest rates today to 1.85%. Still quite a ways below many other central banks like New Zealand and the US, where the US is now sitting at 2.5%. So we're still in Australia, we're quite a way away from the bond market as well. Although the bond market is rapidly buying, which means yields are falling, and those yields will hopefully bridge the gap between the RBA and where the bond market sits at the moment. We've definitely seen that happen in the US markets over the last few weeks since the last Fed announcement. The US 10-year yields are now sitting at 2.5%, 2.57, something like that. And the shorter term rates are sitting something closer into around about, just under 3% now in the US. So that means a massive yield inversion and that draws draws a conclusion. We already know the US is in a recession, but that recession is likely to get worse while we see the yield curve inverting, heavily inverting at that. But basically, the takes that we can get from the RBA announcement today, we've probably received a little bit on the positive side of the market. They've become a little bit more neutral in their tone. I think they've left the doors definitely open for further rate hikes this year. That they're still targeting inflation to come back down near their 2 to 3% target. But what they've left the door open to now is that it's going to be more data dependent. So we'll have to see what that data looks like over the coming months. I suspect that the CPI data, the CPI is probably what they're more so referring to, especially the Fed's been referring to a lot lately. we suspect the CPI is not going to really come down as quickly as what people may think. So the headwinds for me for the market coming up now is the CPI readings. The next one's on the 11th of August, which is only next week. Therefore, that'd be the next big bit of news you want to be focusing on from a central bank point of view. So, yeah, no surprise. I think everybody was expecting a 0.5% rate hike out of the RBA, just as everyone was expecting a 0.75% hike out of the Fed. The front loading, though, out of both central banks is probably done now, but that doesn't mean that they're done lifting rates. They're probably likely to continue to lift rates throughout the most part of this year until we see the CPI readings really start coming down. So it begs the question: is markets overbought? We know markets can shoot up very high on any sort of whisper of a dovish central bank. I wouldn't call this dovish just yet, guys. I don't know. Like for me, really, yes, we probably are close to the peak of interest rates hiking, but I don't think we've seen the peak yet. We've still got an issue of inflation and supply chain and a US recession now to deal with. What does that mean for commodities? What does that mean for discretionary stocks even? So like as people tighten up, and there's always a lag effect here. I don't think we've seen the worst of this recession. We've seen, we've gone from zero interest rates, near zero interest rates from the Fed to 2.5% interest rates. RBA was near zero, up now at 1.85. This is not over, guys. The economy is going to slow down. I can't see this being a V-shaped recovery like we saw last time coming out of COVID. We saw that V-shaped recovery because there was a strong willingness from both central banks and governments to stimulate. Now we don't have that safety blanket. That safety blanket's ripped out for the moment. Interest rates are going up. They're going to continue to slightly go up from here. So I can't see in the short term the markets continue to rally forever on the back of that. With the markets overbought, it's going to take just some kind of catalyst to knock us over. I dare say we're going to go down for more of a W-shaped recovery. So I suspect this 10% increase we've seen recently, most of that's going to get given back in the coming months. But our market especially tends to run a bit seasonally around this time of year, where we're probably going to rise up into the reporting season, which kicks off heavily next week, pull back into the dividends, and then usually September coming into October is a fairly bearish time for the market. So my view for the moment, guys, is we could probably have a mini pullback, a couple of percent, because the market's way overheated. Go sideways up the top here through August. And then towards the second half of August into September, at some point, I reckon we'll have a sizable pullback. All right, so that's probably my prediction for the market, right? Sort of sideways in a 2% range up here that we've seen, around that sort of 7,000 level, maybe even 71, okay? And then we'll probably have a sizable pullback into September. So just furthermore, the US yield curve, you can't ignore that. If that continues to invert further, that's just showing stronger and stronger signs of a US recession. That's probably positive if you want inflation to come down, and you probably will get inflation to come down gradually over time on the back of a US recession. But what's the side effects of it, guys? Okay, and what does it actually mean for the overall markets? For me, if China growth is questionable, and we've seen weaker than expected GDP readings recently from China, and we also have a US recession. So we got the two largest economies of the world growth shrinking, okay, and weak without any real stimulus from the US side yet. What does that really mean for markets? Okay, what does that really mean, especially for value stocks? I still feel there's some short-term pressure here, guys, on that space. And then what we want to see is the yield curve start moving towards normalization again. A view that the US will start stimulating, central banks may start dropping interest rates again, and then that's where you're going to really see a big recovery in markets, and you start seeing markets come back towards all-time highs and into all-time highs again when you get back into that cycle. We're not in that cycle yet, guys, right? So I suspect volatility is still on the table. Last but not least, obviously we've seen a bit of the tensions from the China and US end increase over the last few days. This has come after talks that Nancy Pelosi wants to go and visit Taiwan. China's doing their typical propaganda push around their media. There's a lot of hype building up on the back of this. Just something that a little risk on the table, guys, and it doesn't take much for markets to sell off when they're overbought on the back of things like this. Okay, so there's already a lot of US and Russia tensions going on out there, and obviously tensions with Russia and the rest of the world. But if we want to add more tensions on, and if things keep amping up there between US and China, it's also you're gonna struggle to see inflation come back down if things break out in Taiwan. So there's that risk. I'm not saying it's going to happen, but the risk of that happening could see some short-term volatility in the marketplace. We're seeing weak US futures today, and it could be a result of this as well. Japan was down a good 1.5% earlier today. Now their markets closed, their futures have shot up 100 points, which is not much. But yeah, US futures are sitting a little bit more in the red right now. So this could be the start of a little bit of a pullback, guys. I'd have to say markets are heavily overbought. It's just going to take some kind of narrative or theme to get people on the sell side of this, and we'll have a bit of a pullback. And I'm kind of feeling that's coming in the next few weeks, whether it be China or whether it be the CPI numbers next week. Something's probably likely to pull us back at least a couple of percent, and depending on the catalyst, it could be a lot more. Right, so just keep your eyes out. Be ready to take some profits if you've gone long recently, and look to do a little bit of a short position in the short term here at the moment. That's where I'm at. All right, so look, there's a little bit of a view there for you. Just waiting to see what this catalyst is going to be, and some clear signals on the technicals, and then we'll get some bearish trades out there. All right, so that's where we're at. Thanks for listening in today. Take care, and bye for now.